if you really look at it, going through those four quadrants, you're taking on more risk. Then also, I said before, you're paying less in taxes. So while it might be easy to say, okay, tax the rich, they don't pay enough in taxes. If you want to take on more risk, I mean, if you're willing to take on more risk, then you could pay less taxes. So which is it? Do we just tax the rich more, or do we as individuals decide, hey, I want to increase my income, I want to pay less in taxes, let me just kind of start providing the different services and goods required for me to also take part in that, because it's not like closed off. I will say now that since I've been looking at podcasts over the past couple of years and looking at more in investing on YouTube and different blogs and such, trying to find more individuals that look like me was kind of hard. But now that I've found them, I had the avenues to find them. I can definitely say that, all right, even if I don't see someone in a particular field or area, why can't I jump in? It's not, I can't do this or why should I? I should be like, all right, how can I do it? Hello. Welcome back to the Checkup Podcast. Jay here. Hope you all have had a wonderful week. This year loading up on Monday, so technically, hope you all had a wonderful weekend. Hope everybody was safe. Hope everybody made some moves and just, hopefully got to relax from, work or your hustles, whatever you happen to be doing at this point in time in life. But at this particular time, I would just like to start off the podcast and say that I've been kind of doing you all a disservice, not only just from the time spacing in between the podcasts, since it's supposed to be weekly, but also the fact that I've been running through a lot of the terminology and concepts that I've been speaking of pretty fast. Haven't really been diving into the details. And while I did plan to do that later, I finally got some feedback and found out that I should definitely do that a bit sooner. So instead of rambling on, kind of like how I've been doing so far, kind of assuming that you all would just keep, watching and listening and hopefully get the tidbits that you need. I should try to cater more to those who are not as outspoken. So anyway, moving on from that, I did eventually, if you all saw, but I did post the simple budget that I listed out in my last episode on Instagram. So definitely go and check that out. Link will be down in the description. And I did also compare my current, or at least my expenses for 2021. That technical budget. I didn't really go by it, but this is just kind of how my expenses and transfers align. And I'm going to share that with you all now. Here we go. If you don't remember, most of the simple budgets that I saw online, most of the frameworks that I saw were 50% expenses, 20% savings, and 30%, flexible spending. So that's kind of like your play money, your, taking, I guess, like you going out to eat money, your subscriptions and things of that nature. And I also had some percentages and categories. We will just go through everything. We'll just go through everything this time, actually. So just for those first set numbers, 50, 20, 30. Remember, fixed expenses, savings, and then flexible spending. In my particular case, I have 45% fixed expenses, 40% savings, pretty much 40%, like 39.9. I didn't round up the pennies though, so I didn't take care of every little cent, but this is the general overall picture. And then I have 15% for flexible spending. And just to tell you what categories that all includes, my fixed expenses, the 45%, I included my housing expenses, groceries, transportation, and health. As far as my take home expenses, what comes out of that money. 15%, the flexible spending is gifts and donations, charity and things like that, giving. And then my personal flex spending category, if you all, I have it on Instagram if you guys want to see it. I'll possibly throw a picture of it right here in the video. But that's, going out to eat, cell phone bill, clothing, entertainment, subscriptions, hobbies, pets, since I have pets now, even dating. But yeah, I have to keep track of that. Definitely got to keep track of that. and then the 40% was saving and debt pay down, actually. Majority of that was actually savings, because since right now the school loans aren't charging interest, I'm only putting in just a little bit here and there, but that's definitely going to go up. And while I was content with just paying off my student loans by the time I was 30, I'm really thinking that I should just pay it off as soon as possible, knowing that now it's been 19 months since I passed the net worth positive mark. What does that mean? That means my assets minus liabilities is no longer a negative number. I was actually happy, like kind of excited the day that I saw it hit zero. I was probably looking in personal capital. I don't think I had a spreadsheet ready for that. At least I can't find that particular spreadsheet. But yeah, in 19 months, I've let's see, how can I put this? I told you all I have like over $30,000 in student loans right now. That amount, I mean, I also have like, you know, credit cards, a few other things in there, but that amount of my debt currently, my asset to liability, well, debts are a liability, I'll go over that as well. My asset to liability ratio is currently like 2.3 to 1. So technically I could pay off all of my liabilities right now, like twofold, and then, you know, still have a little bit left over. I guess that's kind of what my turmoil is. Do I want to have, you know, my cash and investments ready for an opportunity that might come my way, or should I be more realistic and say, hey, if I get rid of this now, not only will that fix my credit score, that'll go up, especially when I want to get into my first property, but also the fact that I still have time. There's no need to rush. And if I even find a couple of deals, well, let's say I find some properties that don't look right for me, I still have to wait for that good deal to kind of show up. So that's kind of what I'm thinking of now. But I think I've done well for almost 2 years of passing that mark. And when I graduated, I was negative 40 plus. I graduated in 2019, spring 2019. So that was probably, let's see, between May of 2019 and August of 2020. Let's see, that's 12 months. And then June, July. Well, I'm counting from the beginning of August, like August 1st. So May, and then June, July. So 14 months. So it took me 14 months to get to, you know, net worth zero, or positive technically. And then another 19 months to get to where I am now, where I can pay off my liabilities twofold. I think I'm doing pretty well. And even though you guys, of course, not everyone's gonna be able to copy my framework for how my expenses are, hopefully this gives you all inspiration to actually try to keep your miscellaneous spending, you know, manageable, especially if trying to grow your wealth. And well, growing your wealth is definitely something that you find is important to you, and definitely a goal you want to achieve. In this particular case, well, technically goals, having net worth goals specifically is I think should be more important than having a retirement age goal. Strictly for the fact that, I mean, we all have the same kind of constraint in life, which is time. We can't really get more of it once it's gone. You kind of have to speed up the process to kind of make up, you know, for lost time. Didn't mean to repeat it like that. However, going forward, if you say you want to retire at 45, 50, 60, 60, however you really want to do it, you start noticing, and maybe I'm wrong on this because I'm only 26 going on 27, but if I'm 45 or 50 and I want to retire in like the next 10 or 5 years, at that particular point it becomes more of a income or cash flow focus, because at least to my knowledge, I'm probably behind, and I'm realizing that I don't have enough income to replace, you know, whatever my day job or my side hustles are entirely. However, if I had that particular thinking much later on in my career, then at that point, I don't really have to focus on income. Maybe I can still focus on income, but at least I can start looking at passive income instead of active income, or I can start looking at, all right, I have this income. What have I done with it up to this point? Do I have enough assets to pay off, you know, my lifestyle, pay off all my expenses? In this particular case, what is an asset? And I think the best way to share this with you all is by quoting Robert Kiyosaki, the author of Rich Dad Poor Dad, and various other books. Simplest definition of an asset is something that puts money into your pocket and A liability is something that takes money out of your pocket. That lease, which I'm saying this and I realize it's terrible because I technically have a car and I was like, oh, I should get a newer car. And like when I pay off my student loans, not to like celebrate me paying them off, but just because I'm like, all right, my car is going to be pretty old at that point and I should probably get something a little bit newer and more reliable. But anyway, I was thinking about doing a lease. Anyway, lease or just that brand new car payment from the dealership, that's money out of your pocket. That's an expense. That is a liability. Technically, your primary residence as a single family residence is also a liability. You can always refinance your primary residence. You can always move out of it and then, technically rent it out. You can even sell it. However, until you make that decision, it is taking money out of your pocket. It is a liability. Homeownership is important, but at least right now, or at least how should I put this, for anyone who's relatively early on in their career and their net worth journey going to financial freedom, homeownership probably shouldn't be like the next immediate goal. I would say if you came to wherever United States or you're going somewhere else and you went there for school or simply work and you weren't really sure how long you're going to stay there. If you suddenly say, all right, I have a career here now or I have a family, yeah, you probably want to get into real estate, but maybe in that case you can still live in an apartment as long as it's big enough for your means. Or you can even do a townhouse. Technically, you can do a single family house, or you can even do a townhouse, and you can house hack. That's probably the best way to at least get into it. And that's probably, I wouldn't say the best way, it's probably the easiest way to get into it, because at that point, you don't have to, let's say, refinance out of your FHA loan into a conventional loan, so then you can use that for your next purchase. If you were going to leave your primary residence and turn that into an investment property. Also in that particular case, refinancing your house, it does kind of reset the clock on how long it takes you to pay it off. And even if you own your house free and clear, it's technically, equity is just kind of sitting there. That's technically maybe you're not paying it off anymore. The things in the house, you're probably like your normal expenses, things you have to replace, faucets, microwaves, refrigerators. You have to replace those, but the actual house itself, paid off free and clear, I wouldn't really say it's an asset at that point because you're not tapping into it. If you use a HELOC, home equity line of credit, you can pull that out and make use of it. You can invest that into a different property. You can invest that into a business, stock market. You want to leverage your assets. That's a good way I'll put it. You can also leverage stocks. You can also leverage your skills and talents and abilities. Just depends on what works best for you at that moment in time. So so back to the net worth goal. To be honest, I was doing some calculations, and at least if you hadn't watched my first podcast, probably go back and check it out. I was saying how long it would take me to reach $1 million invested in the market. That wouldn't exactly be, that's only the stock market. That has nothing to do with real estate or business or anything that might happen in the meantime. That was just, all right, I'm manually investing into the market, automatically investing into the market. As long as I don't lose my job, my current job, for what was it? I said my mid 40s or so. If I work until then, I have $1 million invested in stocks and such. But that I still have cash flow. As long as I have a budget in place and my income is much more than my expenses, I have cash flow to invest. I should have cash flow to invest into stocks. I should be investing to courses, classes, continually building knowledge and skills for myself, so that eventually later on, I don't really have to work as hard. You can work hard, and then work smart. Sometimes you have to start in that particular order. You can't always work smart, especially if you don't know what you're doing. You haven't had experiences to then learn from. So assets, liabilities. Very big key, very big key. I actually need to get the Rich Dad Poor Dad book. I definitely need to get that. I don't have it yet, but I will get it. It's in my long list of books that I need to get. So coming next from that, we have how do I plan to increase my income? From this point on, how do I plan to increase my income? Well, I'm gonna be honest. I don't really plan, or at least I'm not gonna say this too well. I'll say it anyway. I don't really see myself in a management position anytime soon. I do have an engineering management degree. However, I'm going to be honest. I was actually wanting to quote this for next episode, but I'll say it. I'll say it here now. Knowledge is not power. Knowledge is potential power. I paid to go to college to gain knowledge, and for that knowledge, I got a degree. The job I get based on that degree it's not like I can't say, all right, I have my degree now, I can go to any company, get in, any particular salary. Like, no, it's all, I wouldn't say up to chance. It's all negotiable. What job I work at, what location, the actual title I get, the range of income that's available to me based on the value that company, sees that I can bring. So in that particular case, I have to make use of that degree to its fullest extent, and I can only really do that, I guess technically, once I'm in that position. You can. I did say I went to career fairs. I got some interviews, but I'm probably one of those interviews that they actually sit me down and like probably work out some equations and some terminology and everything. Other than that one time, everything else just kind of asks me, all right, sell yourself. Why should we hire you? And that's just generally how it is. And I wasn't good at it at first. Eventually I got better, but it just, I guess it didn't work out for me. But at this particular case, I'm trying to be more knowledgeable about finance specifically because I know, whether it's, you may not like the statement, but money kind of makes the world go round. Money does not equal happiness. Money, I would say, is a means. So you can be happier if you have the money to go on that vacation once or twice a year. Sure, there you go. Like you have the money for it. But to begin from that, either you just needed to make a lot more money and not spend it and just be like, oh yeah, this is fine, or you had to budget it out. Some people really need a budget. I kind of think everyone needs a budget. To be honest, why shouldn't we treat our normal daily lives like a business? Technically, we work at a job. Technically, we bring in money. It may not be our customers specifically, it's the company's customers, but we bring in money. We have expenses. We should try to have more control over that. And that's kind of how I'm looking at everything right now, even though I just said I wasn't really going by a budget. But I'm going to be honest. I've been living by myself since like, what was it, summer of 2020, like fall of 2020. So almost 2 years now. My expenses don't go up and down very much outside of really random things like my car engine destroying itself, things like that. And to be honest, and also me paying down my student loans, which when I did this budget, I did not take account out of any expenses that I normally would have paid for out of my savings. There's definitely times where like, all right, I went to travel. I didn't take that money out of my savings. I just knew I had the money, in my checking account or like that immediate savings account. So like, I don't want my checking account to have all my money in it because if someone gets my debit card, that's going to be an issue. So I have Chase. So I have like, the checking and savings. It's right there. So basically I kind of see them as the same thing. I'm not really going to get interest rate in Chase anyway. So they're just kind of both a checking account, but I just move the money away from the checking so that, I can't get screwed. No one can access that accidentally if I put the wrong number in or leave my card somewhere. But anyway, in that particular sense, the money was there. I was like, all right, okay, I can use it to travel. Bad thing is that when the big expense came to fix my car, I should have dove into my savings because that's what an emergency fund is for, right? 3 to 6 months of funds at the ready, and it should be your normal expenses. But I guess in that particular case, let's say if you had $1,000 of rent, if you had 3 months of rent and you had a car expense like mine, it was $4,000, it wasn't enough. That's why I kind of say you should be on the higher end. I mean, if 6 months of your normal expenses doesn't cover something that's not particularly health related, then I'd really got to ask then, okay, maybe you just have a really good living situation. You may have roommates and all of that, but then you may have a car that's possibly worth more than what's in your checking account. It's possible. I don't know. It's very possible. You want to make sure that, your liabilities, you can pay those off. Not only with just like the monthly payment, but if you go and just buy a car cash, you have to maintain that vehicle and I'll be honest, some of them Swedish and German vehicles, they cost quite a pretty penny. Even Japanese cars, they aren't the cheapest. I'm pretty sure the American companies are probably, at least over here, possibly the cheapest. They may have issues a little bit more often, but you can just go to the store and fix it right away. My little hybrid hatchback that I'm chugging around in, that's Japanese, I can't do anything with that car underneath the hood. It's not gonna work. I can't even try. I could probably change my oil. Outside of that, nope. Too many things in the way. Cannot get there. Getting back on track. How do I plan to increase my income from this point on? So if I don't see myself in a management position anytime soon, I can either just move horizontally in my company if there's another position in a different department or even the same department that looks good, has a bit higher pay. I could do that. Technically, I don't know if all companies do. Some companies do give yearly raises, or if they don't do yearly raises, they possibly do bonuses. And sometimes the bonuses are fixed depending on what company you're from. Sometimes you don't even get the bonus and you don't get a raise. I do have some friends that are in some pretty nice companies right now, and if they don't get the bonus, they get nothing. I have other friends I know that possibly could get both. Just depends on where your company is. Make sure you keep that in mind when you're applying. So what else can I do outside of, my day job, my 9 to 5? Well, overtime is nice. It doesn't fix the issue. It's not an additional source of income. It's just more income. So when I say increase my income, I want to, of course, increase my income in all facets, no matter where it's coming from. However, I want to make sure that I'm spending time to grow other sources of income. So right now, I'm looking into doing stock options in Robinhood, just because Webull, for whatever reason, some of the strategies I want to do, Webull just doesn't allow me to do it. Thinkorswim, I need to check. I think I can do it in Thinkorswim, but I need to go back and check. I think Webull is the easiest because I can do it on my phone as well. I don't have to log in on the desktop to get the mobile app open. The desktop app open. Outside of that, real estate. I don't know if I'll be able to buy real estate property every 2 to 3 years or even every 1 year, but that just depends on how good the deal is and how much money I can stash away. And of course, as long as the cash flows, or I can refinance it, 6 months to 12 months later, get some money out. That would be also good, doing the BRRRR strategy. I also realized I said the BRRRR acronym wrong the last time I said it. So it's buy, rehab, rent, refinance, repeat. So B in 4 R's. Buy, rehab, rent, refinance, repeat. If you definitely want to learn more about that, you should Google BRRRR. You should also check them on YouTube, the Bigger Pockets podcast, BRRRR. They have plenty of podcasts on. You guys can learn a lot about it. And I live in Chicago. It's a pretty expensive market, but there are people who are still upgrading single family houses, possibly turning single family houses into duplexes, or taking smaller duplexes and just fixing them up. So I'm just like, all right, I just need to get in the game. So I'm gonna be looking. Definitely will be looking. Aside that, what's next? So I'm getting more into content marketing. Technically, this podcast is one of the avenues where I'm trying to achieve content marketing. So content marketing, in a simpler sense, let me see. I just had a tab open. So it's mostly creating brand awareness. So you're creating content. So it could be videos, it could be clips, it could be posts, and I can post them. Of course, didn't mean to say double posts. I can upload them to Facebook, Instagram, YouTube, pretty much anywhere. TikTok, yes. I'm trying to TikToks out, but hey, it seems to be working. It doesn't seem to be doing too bad. So we'll see where it goes from that point on. But yeah, and then so I guess the content marketing kind of leads to like the influencer kind of ring to it. It may not have the best connotation in some avenues, just because some of these bigger influencers, they're kind of scammy. Trying to run up crypto plays and all this other stuff. It could be a rough world out there. So always do your due diligence when you're listening to people on TikTok or YouTube, Instagram, whatever, Twitter. Do your due diligence. Know whatever that is that's supposed to be an asset, or I guess I could say it could be a play, to make some quick cash. Make sure you know exactly what's going on. Don't just take the word for it. Don't do that. And I kind of mentioned this already, brand awareness, creating a brand. So right now for Jay Abundant, which is what this YouTube channel is called, this is more of a personal finance investing kind of community that I want to start here. And I don't really have any merch design yet. I have a few ideas that I've written down, but of course, the first thing I do with that is I could, try to get the YouTube monetized, get some YouTube ads, some AdSense from that. I could even have this all, what's the word for it? Oh my goodness, I'm forgetting it again. But take everything I'm saying live and put it in text, and I can put it on the blog. There's also display ads there as well. Patreon. If anyone wanted to support what I'm doing here, I can usually do a Patreon or Cash App, probably Patreon, and kind of do some behind the scenes and, probably do some live streams as well. And then of course, merchandise, if I ever want to do that. I don't know if I want to do like pay on demand with like Printful or Shopify kind of deal, or if I actually want to kind of do it all myself in house, getting myself a heat press and then kind of doing, what's it called? Oh, wow. My brain goes too fast sometimes, but there's a particular type of way that you can make shirts. Screen printing, kind of getting the screen printer sheets and actually using them with the heat press to kind of make some nice designs. We'll see. I definitely have to check it out. Probably go to like the mall one day and be like, hey, how'd you make these shirts? And kind of seeing what it feels like. I have an idea. I think I know what it's going to feel like, so I'm trying to find the right method. But if I do that in house, it would allow me to keep more of the profit to myself. So we'll see how this goes. But yeah, that's what I'm looking at right now for increasing my income. And what's next to that, why I think everyone should be focusing on income growth. Like I mentioned earlier, maybe later in life, you want to look at passive income or looking at like your complete net worth for retirement, or if you want to relocate, things of that nature. But simply because we all pay taxes, the government gets their cut of money, no matter how we make it. Like that Cashflow quadrant from Robert Kiyosaki as well. The employer, self-employed, business, and investor. As you move over to that side, from the left to the right side, you pay less taxes. As you move from the top to the bottom, you also pay less taxes. Now, it's very possible that the self-employed may pay more taxes than the normal employee, but that depends on how your business is set up and really, kind of what role you have in it. Even if you have like an LLC, you can get that's only like a legal entity. You can technically get elected to pay whether as a solo proprietor, or you can have partners. If you make enough money, you can even do an S corp. S corp is kind of the better way, I think, but you have to make enough money, and you have to definitely go through some very strict requirements to get that election. But it's definitely possible. But yeah, and it may not have looked like that as I was kind of listing them out, but if you really look at it, going through those 4 quadrants, you're taking on more risk. Then also, I said before, you're paying less in taxes. So while it might be easy to say, okay, tax the rich, they don't pay enough in taxes. If you want to take on more risk, if you're willing to take on more risk, then you could pay less taxes. So which is it? Do we just tax the rich more, or do we as individuals decide, hey, I want to increase my income, I want to pay less in taxes, let me just kind of start providing the different services and goods required for me to also take part in that, because it's not like closed off. I will say now that since I've been looking at podcasts over the past couple of years and looking at more in investing on YouTube and different blogs and such, trying to find more individuals that look like me was kind of hard. But now that I've found them, I have the avenues to find them. I can definitely say that, all right, even if I don't see someone in a particular field or area, why can't I jump in? It's not, I can't do this, or why should I? I should be like, all right, how can I do it? If I'm the first, how can I be? If there's no one else, how can I be the first? And if I'm not the first, then how do I learn from the other people that came before me? It's technically a free game. If you could get in touch with these people and just ask questions, you can get into those rooms. But yeah, taxes, expenses. They say real estate appreciates 2, 3, 4, 5% in certain areas, maybe even more, especially on like the West Coast or the East Coast. If your rent goes up every year, it's most likely because of that. Outside of that, taxes, there's only a few states that don't have state income tax, but actually, are there 11 or 9 states? Let me see. Let's see right here. I'm gonna get this out for you. State income tax exempt states. I have a mechanical keyboard if you heard that. It's quite loud. Yes, it can be. Which states have no income tax? I'm seeing a list of 9. There are 9 states with no income tax, and they just happen to be Alaska, Tennessee, Wyoming, New Hampshire, Florida, South Dakota, Texas, Nevada, and Washington. There you go. States with no comparison of states with no income tax. So state income tax or sales tax. So yeah, I mean, it's decent. It's decent. I don't see, but yeah. So there, but that doesn't mean that, you know, it's going to be immediately cheap to live in those states. Just gonna throw that out now, just in case any of you were thinking about it. So lower tax bill. That's one way to do it. Outside of that. So, oh, it didn't, like I said before. So I guess here's another way to put it, because I said investor and then I mentioned stocks. I'll refresh that idea and say for investor, after getting more into, like, you know, the real estate sphere, investors love debt. Debt is how they offset most of their income. Also with, you know, if you're a business, then technically you have expenses that you can technically deduct from your income as well, but that's one of the big ones. So next. Back to where I was saying, okay, maybe I should start opening up some of these topics in a bit more detail. Here we have what I want to talk about next is starting your nest egg, the beginnings to stock investing. So first, you got to have a budget. You got to have money that you're willing to set aside. I would say for a minimum of at least 5 years. I'll stress that out. 5 to 10 years. You want to have the money. You don't want to touch the money at all. You want to just let it grow, let it do its thing. And then guess what? If you do that every year, after 5 years, if you're constantly investing, look at how much you'll have, and then compare it to where you started. You know, it's a compound interest, very, very powerful force. It just goes and goes and goes. And if you have a very good, you know, couple years like we have now, you can see some really nice gains that are possibly better than, you know, the average in the stock market. But it could also be, you might also see some losses. It's very possible. It's not like it can't happen. Most of our financial recessions are pretty short, but who knows? If you're trying to retire in that year, you might have to wait an extra 6 months. You might have to wait an additional year. Who knows? Just make sure you are prepared. So have money set aside for 5 to 10 years, have it available. But this has to come out your budget. So I would say at least every month you should put money into the market. You could do every 3 months. I would suggest monthly. I do weekly just because, I mean, the stock market's been going a little crazy. It's been a little volatile the past 2 years. So I just kind of throw in money every week. How I said before, but I did go into that. I said how much my budget was for these different categories. Oh, I said the 50, 30, 20. I didn't go into the individual categories. Apologies for that. So as far as my take home, 2% is in gifts and donations. 28% of my take home income goes to housing expenses, like 29%, really, pretty much. 5 to 6% is on groceries. 4% is on transportation, you know, gas, car insurance, maintenance of that stuff. 7% is health, so my life insurance currently. I have some with my job, and then I have some outside of that. Another 13% is on my personal flexible. I did the gifts and donations plus the personal to make that 15% from the beginning of this podcast. 38% is savings, and that's long-term investments. I put on here 7 years plus, but again, 5 to 10 minimum. And then I have another just about 2% on debt paydown. Now, that debt paydown is definitely going to increase pretty soon. I believe the student loan hold was supposed to end in May, which at this point is only 2 months away. But I think they're looking at it pushing that out again. I really hope they do. But again, I have the ability to pay off my student loans right now, but I'm still trying to make that decision. Still trying to figure it out. So what's next? Your brokerage. Choosing a brokerage to automatically invest your money with. You shouldn't even have to manually think about it. You should just take money out of your account every week or every month. Also, just make sure that, you know, your account doesn't, you know, go negative. So make sure that whenever you do have this money come out, usually you can choose the day of the week that it does it, or at least, the first couple of days of the month. Make sure that you have money in there, and just remember that it's gonna hit. I had to do that myself with like my credit cards. I have certain days where the payments come due. I have 3 different credit cards. They're all on 3 different days. I don't use the max on any of my cards like that at all, not even. However, I need to know that, hey, if there's an expense on that particular day, or if maybe I spend a little, how can I say? If I put money into the stock market and my account's really low, and then my credit card's about to hit, like I might need like $10, $20, $40 to pay it off, that statement balance, or that minimum payment. I would suggest doing statement balance. Always do statement balance, just to make sure you don't pay any interest. I'm gonna need to move some money from my savings to put it back into there, and then when I get paid next, put the money back in my savings, so everything's fine. So next, we're gonna talk about the available brokerages, what I use, and what you could potentially use. Here's what I'm going to start with when it comes to investing apps, stock trading apps, however you really want to call them. I generally don't go for robo advisors. I know some of them are probably only listed as robo advisors. Some of them kind of have that feature in them. For instance, Acorns, Betterment, Wealthfront, possibly M1 has that feature as well. I don't really use it if it does. But those are the ones I mostly think of when it comes to robo-advisors. And mostly what those do is that you put your money in, they put it in their funds. I guess you can kind of choose like your investment, risk or strategy, and it just puts it into their funds. I have no idea if you know exactly what those funds entail, like the percentage of what stocks or ETFs they're put in. And then also those funds change over time. And then I don't know if they tell you the expense ratio for those funds either. So that's why I usually don't go for robo advisors. And then also, I really don't like Acorns, because at least when I first heard about them, I don't know if they still do this, but they charged a $1 fee like per month until like you had a certain amount in there. And if you're only starting with like $100 to invest, and you're losing 1% of it due to fees every month, like that's a terrible deal. It may not have even been Acorns, it may have been somebody else, but if your robo advisor does that, don't do it. And then there was another one. Actually, at this point, I think everything is Acorns at this point. But there was one where it would let you round up your transactions and then take the change out of it. So if you paid like $7.80 for like I don't know, something at Starbucks, you could take that 20 cent, round it up, and put it into your investment account. And that's cool, I guess. Like younger people who don't have a lot of income, that's fine. But if you actually have like a part-time job in like high school or college, or a full-time job, I don't think you need Acorns, because the amount of money that you should be trying to put in at that point, at the early start of your career, technically, you need to start with more than just 20 cents a day. It's not even gonna work for you. I would even say that some people say, oh, you could do like $5 a day, Well, here's my thing. I'm not trying to invest for 40 years to reach $1 million. I'm not trying to do it. Even though it sounds like a good idea, I want to reach my $1 million way before that, because a lot can happen in 40 years. I'd rather not wait that long to like get anywhere near my financial freedom. Also, on top of that, like I had said before, there's lots of things that I believe a budget, gives you the opportunity to do. It gives you opportunity, gives you control of your money, and then also it helps you achieve like your goals as well. And as long as I have a budget in place, why am I worried about, oh, okay, I don't need to put any money, I'm gonna let this robo advisor take, my change every once in a while? It's like, no, I'd rather just put 10, 20, $50, however much I can, each week or each month, and then just kind of snowball that and just keep adding more as like my income increases, or adding more once I get my living situation down. I mean, I guess, to be honest, I have the financial calculator here on my phone, and I could even just say, all right, if I started with $100, we can just say $100, maybe not everyone has $500 to open an account. I think most Roth IRAs require $500, but we're just going to say, if you're allowed to put in $100 at the start, and let's say you did $5 a day, the market's only open for 25 days 5 days out of the week. There's 52 weeks, so 5 times 52, that's 250, 260. So 260 days. So monthly deposit. Let's just put in like $50 a month. Let's do $50 a month. We're not gonna start to do all this daily math. And again, 7% compound annually. So start with $100, $50 a month. In a year, that's $729. That's not bad. You got $30 of interest. That's not bad at all. But let's say you did $50 a month for, let's just say 5 years. That's $3,700. 620 of that is interest. That's, about a fifth of what you put in. But where are you going at this rate? Let's keep going. So 10 years is 120 months. 40 years is 480. You're not going to do this for 40 years, but I'm just saying, like, looking at it, doing that $50 a month for 40 years is $125K. I would be scared to be, even if I started investing late, I wouldn't even consider this investing early and sticking with it a very good job. Of course, I doubt your change at the end of each expense is going to add up to $50 a month. It's just not, unless you spend, you swipe that card a lot. But okay. But yeah, I'm trying to get to my 100K invested before I'm 30. By the time I'm 30, at least, it's just not doing it. Now, starting off, it's fine, but I would really say if you're really trying to get like to a certain place in life, starting off with something like that just really isn't realistic, because you're gonna need to go from cents to a couple dollars to tens of dollars. Like that ramp up is gonna be kind of slow. And like I'm saying, if you actually have a part-time job, I know you guys are probably out there, taking a little bit of that money aside, going like, oh, I got my little spending budget. But if you're not living alone, you have a part-time job, you can save some of that money. If you're staying at home, you can save a little bit of that money. Because I know you want to go out to the movies and go out and hang out with your friends and all that good stuff. I did it too. That's why I had an on-campus job from the time I started college till I got out. I didn't want to keep asking my parents for money. I wanted my own money. So moving on from that, brokerages. So I use multiple brokerages. I'll list them off again. I use M1 Finance. That's what I use to invest money every week. Taxable account, which is it is all after tax money. There is no tax sheltering in that at all. It's not tax deferred. It's not tax exempt. Everything I make in there when I sell stocks is taxed at that point. And if it hasn't been held in there for over a year, it's taxed at my normal, income rate, which at this point I think I'm in the 24% tax bracket. Anything held over a year that I sell in stocks, that you might hold for over a year in stocks, you'll get taxed at a lower rate. I believe it's 15% for long-term capital gains. Definitely, let me look at that again. Long-term capital gains tax. Just so no one comes at me and says, hey, you're saying this wrong, Jay. You're saying this wrong. So, we have multiple long-term capital gains. Oh, it depends on your tax filing status as well. So, single between, oh yeah, definitely. So, if you make between $40,000 and $445,000 in 2021, and it's about $41.5 to $460,000 in 2022. Let's go with the 2022 numbers. Capital gains tax rate is 15%. The long-term capital gains tax rate. So anything less than a year, you just pay your normal tax rate on. So there you go. That's one way to pay less in taxes. Hold your investments for over a year. Definitely. So outside of that, I do have a traditional IRA, which, like a 401k, is tax deferred. So while a 401k, the money is taken out before it gets to your paycheck. When you sell stocks in your 401k later on, whenever you do retire, whenever you want to withdraw money, if it's not for like a particular health expense, I believe possibly education and like a down payment on a house, you're gonna get charged penalties on that. So if it's not for one of those reasons, if you are of age to pull that money out, you'll just pay whatever your tax rate is at that point in time. So you don't pay any tax on that until you sell, and hopefully that's 10 plus 20, 30 years later. When it comes to a Roth IRA, that is tax exempt. So that is money out of my take-home paycheck that I put in for like savings, like my taxable. That's all money that I'm taking, that I got in my in my check And I said, I'm going to put some of this aside, put it in a taxable, I'll put it in a Roth. But in the Roth, it's tax exempt. However, my contributions I can take out at any point in time. So if I put in, the max is 6,000 a year. If I put in 6,000, I can take that 6,000 back out and it's fine. Now, any gains I made on that $6,000, that has to stay in because that will get penalized. And I sloppily explained this last time. I talked about it, but I'm going to go into detail about that now. Since we're talking about brokerages, you definitely make sure your brokerage has whatever option you want to start. I recommend, if you don't have an investment account right now, to start with the Roth, because you don't know what your tax bracket is going to be like in the future. You may be making tons and tons of money, and you don't want, you may want, if you have money in your Roth you want to take out, you may not want to get taxed at that rate. So that's what I say you should start with the Roth IRA if you can, if you don't have anything else. Once you max out your Roth, hopefully at that point you have a company that provides you a 401k, start putting money in the 401k, get that match. And then if you really want to, if you can, I would suggest the health savings account. That's a triple tax advantage, so tax deferred and tax exempt, depending on using that money for health expenses. But you can get some of that money out, without penalties if you pay for your health expenses at the hospital or the dentist, whatever, out of pocket. And they can use those receipts to kind of pull that money out, later for free. There's a few other accounts we're going to talk about as well. If you want to start setting aside money for your kids, custodials versus 529s. But anyway, we're going to start with the Roth. So whether it's traditional or a Roth IRA, it's only $6,000 a year at this point in time. If you're older, there's a catch up. But I believe it puts you to 6,500. Can I see that somewhere? Oh, I can't even find the catch up. I know the 401k. Well, some of these other accounts definitely do. So contributions, tax breaks. Also, here it is. So the 5-year rule with the Roth IRA: if you're under 59 and a half, your earnings are subject to taxes and penalties. If you're over 59 and a half, you pay no taxes or penalties. So that's the age requirement that I was just speaking of. So if you're under 59 and a half right now, which I'm assuming most of you would be, your earnings in your Roth are subject to taxes and penalties unless you can take them out for very specific reasons. And you can find those online as well. If you don't meet the 5-year rule, which means the 5-year rule as in like you've had money sitting in there for 5 years. So let's say you just opened up your Roth IRA and you're under 59 and a half. Your earnings are subject to taxes and penalties. You may be able to avoid the penalties, but not the taxes if you use the money for specific purposes. So that's where it comes from. So under the 5-year rule, under 59 and a half, both of those together, there are only specific purposes you can take the money out for. If it's over 5 years and you're over 59 and a half, which I mean, at that point, both of those should match up pretty easily. Your earnings are not subject to taxes or penalties. Now, if you're in between, if your money has been there for over 5 years, but you still aren't 59 and a half, then like I said before, it's just taxes and penalties. So, it's you definitely just want to like take note of this and go see exactly what those particular circumstances are. At least at my point, I don't meet the 5-year rule. So I would get taxed if I took money out. If I did qualify for any of those rules, I would just pay taxes on it, not the penalties. But outside of that, the penalties are going to hit, and the penalties are hit pretty hard. But if you don't meet the 5-year rule and you're over 59 and a half, your earnings are only subject to taxes, but not penalties. So quick refresher. The penalties, if you're not subject to taxes and penalties. Oh, I actually had a nice diagram for this back in the day when I was trying to explain this to a friend. How do we put it? So, subject to tax, not penalty. So, if you're 59 and a half or over, no matter how long the money has been in the account, you do not pay penalties. Over 59 and a half, you do not pay penalties on your earnings. Now, if you're under 59 and a half, you will pay penalty and taxes, but there is a way to avoid the penalties if you don't meet the 5-year rule. And then the very last one, if you're over 59 and a half, you can, and you do meet the 5-year rule, you will pay taxes. So that one's kind of off by itself. So we can see age, no penalties. Age and 5 years, no penalties, no taxes. But age and depending on the 5-year rule is whether or not you can avoid the penalties. But again, do your due diligence, look this up online. That's the account. Again, this is the account I suggest most people start with if you don't have an investment account at all. Because even right now, like if you don't make a lot of income anyway, you're not really worried about getting, taxed very harshly anyway. So open up a Roth IRA. So outside of that, taxable account is, you can open that with any brokerage. If you do max out your Roth, you can, just a normal account. There's no tax sheltering on it. You're going to pay tax whenever you sell or pull money out. So as far as brokerages go, I use M1 Finance. Like I said before, I have money in Thinkorswim, which is TD Ameritrade's trading platform. That's what I was thinking about, like, not day trading, but most like trading, not really investing. I was thinking about doing options in there as well, or at least getting into stock positions using options. That is something we can talk about at a later point in time. Webull, it's pretty nice. It's you do have to subscribe to get like the up-to-date stock prices, like not delayed. I think it's like $4 a month or something, so it's not that bad. Robinhood is the easiest. It's free. You don't get like all the analyzing tools and charts and all that stuff like with Webull or Thinkorswim or even Fidelity, but it's pretty easy to use. They do use market to order flow, which is a little, some companies like Public, they don't do that, so they don't make money off of you, trying to put your orders in. But Robinhood's pretty easy. I say try it out if you really want to. Otherwise, Webull and M1 Finance are nice. Thinkorswim is kind of high level. You have to really learn that platform if you really want to get into it. Public is also easy and free as well. And like I said before, they don't do order flow. Let's see. When I was thinking about getting into a stock trading course, day trading, swing trading, it's about a $2,500 course. It's very expensive. They use TradeStation, but I was probably going to still stick with Thinkorswim. I'm pretty sure, the concepts can go between any brokerage. Possibly even some of those concepts can be used for crypto. And then I have an account at Tastyworks, but I don't have money in there. I just use their tools, their stock, their option analyzing tools. And as far as crypto, we don't really have to talk about crypto now, but Coinbase, Gemini, BlockFi, that's all I really use. So let's see what's next. So brokerage. Outside of that, what else would I really recommend outside of stuff that I use? E-Trade is pretty good. Like I said, I have TD Ameritrade and Fidelity. Interactive Brokers is nice as well. TradeStation if you want. Those are good as well. Like I said, I have like 3 out of the 5 of those that I just mentioned. I don't really like robo-advisors, but if you really want to use them, no problem. Do what you got to do. It is your money. You put it where you want. But again, some of these apps are more for stock trading, so they're going to have a bit more informative tools. They'll look a bit busier, so definitely kind of just open an account. You don't have to put money in to start. You can even just go on YouTube and see how some of the platforms look and pick from that, or you can just use what I use. I have links down in the description. We could both get some free stocks if you sign up and deposit, I believe, minimum $100 into one of the accounts. Yeah, I'll update those links if need be as well. So definitely take the description. What's next? So what are stocks? What are ETFs? What are index funds? So here's how it goes. So here's how we're gonna do it. We're gonna. I usually like to start from a high level and then come down, but we're gonna start small. So you can invest in a stock. If the stock is less than $1, if it's less than $5, like penny stocks, I would really avoid it at all costs. Don't do it. However, you can invest in quality stocks. They range anywhere from maybe $10, $15 all the way up to something like Amazon, which is over $3,000, or probably under $3,000 right now, actually, because the market's going down per stock. Now, the majority of these apps allow you to invest in fractional shares. It's a fancy term. All you need to know is that if you throw $10, $25, $100, whatever amount of money in there, you can still buy stocks. You just won't have one share. You won't have a share of that stock. When you buy stocks, you buy shares, and that's what the price is. So if there's a $100 stock, you have $100, you can buy one share. If you have $50, you can buy 0.5 shares of that $100 stock. Get it? Little simple math. If I would suggest not picking individual stocks when you start off investing. I would say to choose an ETF, an exchange traded fund, that follows one of the big stock market indexes. So as far as over here in, I guess, North America, I guess possibly just the Americas. No, I'm going to name Americas because they have their own thing, like Canada and Spain and Mexico, they have their own. I'll say Spain, Canada, and Mexico. Anyway, North America, we have the S&P 500, the NASDAQ, and the Dow Jones. Those are the three big ones. If you wanted to look at more total market, you can find the Wilshire 5000, or even the Russell 2000. Those are like, they have thousands of stocks as well, but they have a lot more stocks than like the S&P, the NASDAQ, or like the Dow. The Dow only has like 30 stocks. The S&P 500 of the biggest stocks, actually it may even have just under 500 stocks. The NASDAQ, it's pretty big as well. These are all on like most of the major exchanges, so you guys don't really have to worry about it. But yeah, so I would say find an ETF that follows one of those three exchanges, S&P 500, Dow Jones, or the NASDAQ. In my preference, I would say S&P 500, then the NASDAQ, then the Dow Jones, in that particular order, just because you want to be diversified when you start investing in stocks. Because let's say you have like 5 stocks, you throw $100 in, some of those stocks might jump up or down 10 to 20%, and then your money is just going to be looking crazy. You're going to be like, oh, why am I investing? It's going down. Which, if you have your money set aside for 5 to 10 years, it shouldn't matter if it goes up or down. You should actually want to buy more when it's down, because then it's cheaper. See, you buy the dip. All right. If you've ever heard buy the dip, that's what that means, whether it's stocks or crypto. If you think it's going to be more valuable 5, 10 plus 15, 20 years from now, buy it when it's cheaper. So when you sell it later, eventually, or, it's giving you dividends or interest, well, guess what? It's worth a lot more at that point. So you have a bigger gain in that particular sense if you sell. Or if it's paying you interest, if it's worth more in general, you'll get more interest. That's how it works. If you guys want particular stock tickers, so if you want to go like Google, you could just go to Google and type most of this in. Like if you could type $, so go to Google or whatever your browser is, you can type $, and then you can put in Amazon. $ Amazon. Actually, no, that doesn't do it. Interest. Oh, because I'm not actually in Google. I'm in Microsoft Bing. Oh, goodness gracious. I need to switch this over in my browser. So go to actual Google, $ Amazon, and it still doesn't. Actually, you have to put in. Okay, so just put in ticker symbol AMZN. If you want to invest in Amazon, that's the ticker right there. And usually Google will pretty much give you a chart. If you just put in AMZN, if you find stock tickers and just put them in Google, it'll pull up like a whole chart of like the stock performance. And then you'll kind of be able to go between like a day, a year, year to date, 5 years, and kind of just see how the stock is going up and down in price. Using one of these investment apps, you should be able to actually go into the chart like Webull and Thinkorswim and actually like, start putting filters and studies and everything, but we're not going to go into that now. So as I said before, you can just go into Google, type in a company, and usually somewhere on that page, you're going to see a stock ticker. And usually it's going to be 3 to 4 symbols or letters. It says, very interesting. I thought I could just do that. But you can also just type in, let's say you want to Amazon, type in Amazon stock. It comes up. Let's see if I type in Apple space stock, it shows up. So yeah, so just type in whatever company and then stock afterwards, and you'll get it'll pop up in Google. You'll see the ticker symbol. You'll also see the current price per share. Like I said before, some companies are growth companies. They grow really fast. Some companies are more value companies, so they kind of stay at a lower price, and they can be good for long-term holding. A lot of them pay dividends as well. That's what a lot of the Dow Jones is made of, blue chip dividend stocks. And then you also have, well, I said growth, value, and then I said dividends. So that's basically it there. The trifecta, there you go. So we have that, we have that, we have that. And then, like I said, you should automate it. So go into that app, tell it to take money out of your accounts, your main checking account, however often you feel comfortable doing so, at a rate that you're also comfortable putting money aside. So let's say you go by the normal budget, save 20%. If you make $1,000 that month, if you feel comfortable putting $200 aside, or if you can put $200 aside because your expenses aren't, extreme compared to what you're making, and hopefully you're not like in, negative cash flow consistently anyway. Have it take out $200 at the end of the month or at the beginning of the month, or like right when your check hits, maybe in between your checks, just have it like on a Friday or something, or a Monday. Right now I'm investing on Mondays. I was investing on Fridays before, but I moved it to Mondays. I just feel different about doing it. It's personal opinion. But yeah, just have it automated. You even got to think about it. You don't even need to look at it. I look at my accounts. I used to look at them daily, but now that they're like growing, I've had them open for like, I think I've had one of my M1 accounts since 2019. I definitely had it since 2019. I don't know if I had it in 2018. I possibly did. Very, very possibly did. I was looking at my accounts every day, but then I was also kind of learning about finance, so I was stuck to it because I'm like, oh, what is it doing now? Now I probably check my accounts once or twice a week, unless I'm actually looking at something to invest in. So I'll look at a stock or I'll look at an option, and we'll go from there. And then that's actually everything. That's actually everything I want to cover this episode. Yeah, that's nice. That's nice. That's nice. But once again, if you need to go back and listen to any of this, please go and do so. Hopefully I didn't talk too fast, but I'll try to slow it down in the future if you guys need me to. Put any questions or comments in the description. Check out the Instagram page. I did post the budget. My simple budget is there as well. It's a nice little infographic I made. If you guys want me to post anything, any other images that I mentioned earlier from like the Cashflow quadrant or anything like that, or if you wanted me to probably post some of the images for the logos for any of these investing apps, I can do that as well, especially the ones that I use or recommend. I can post that there for you as well. Yeah, definitely remember that if you want to use any of these links in the descriptions, most of them they're pretty much all affiliate links. Some of them are they're just really just information sources for you. So anything I looked up on Google or had an article for, you can check back and kind of read through anything that I didn't go too far in detail with, because we don't want this to go on for forever. But we can also cover any of that later in the future as well. And yeah, you can also just contact me on my Instagram as well. That's the only other place I'm really posting content for Jay Monday right now, but I'll possibly get on TikTok and Twitter eventually. We'll see. If you guys think I should, let me know. Otherwise, I will keep posting podcasts. There will be 2 episodes this week because I actually already have the next episode planned out right here in front of me on my OneNote. Along with that, make sure you like the video. Again, I'll answer any questions or comments that you may have. Technically, you guys can find me on Facebook as well if any of you guys actually know me personally. If you don't, just let me know. You can, Facebook Messenger or WhatsApp. We can talk. Yeah, I hope you all have had a fantastic weekend once again, and I'll be seeing you very, very soon. So, wish you all a good night or good evening. And once again, check your finances, keep in touch on it. Make sure you're going professionally, socially. Make sure you're being healthy as well. Get some sleep. It's almost 2 a.m. where I'm at right now. Should be going to bed right after this. We'll see if that happens. Anyway, everyone, thank you for checking in again with the Checkup Podcast, and start checking some of these to-do things off your list, because I know some of you have probably just been listening and haven't been writing things down. So definitely get some notes. I'm going to ask some questions next time we come on the podcast. Anyway, thank you once again. Bye-bye.